Welcome to the Executive Real Estate Investing Show. This podcast is for you, the busy business owner or executive looking to create generational wealth. Here, we're going to show you how to do that through real estate investing, from multifamily to industrial and everything in between. You will become a real estate investing expert. And now, here's your host, Michael Holman.
Hello, everyone, and welcome to another episode of the Executive Real Estate Investing Show. As always, I'm your host, Michael Holman, and we have a great guest with us today. Excited to get things started. His name's Scott Crone. He's done a lot of stuff, and you know what? He started in architecture. He moved into development and investing. Fantastic personality, and one of the things that you're going to see that I absolutely love about this interview is he pulls his head oftentimes out of the real estate sand, right? I love hearing that because you get all of these people, all of these real estate investors and sponsors who started in 2015, 2016, right? And up till now, and it's like, wow, life is great, right? Like things couldn't be better. Things are moving forward. And it's really important. I say oftentimes to people, look, you have to understand a recession and you have to understand what it's like going through a downturn, right? Because whether it's 2 years, 10 years, 20 years, a recession, a downturn is going to happen. And if you don't think that the broader economics of the entire country, nation, everything that's going on is going to affect real estate, think again. It happens all of the time. And so he specifically talks about these pillars, right, of real estate investing and what you need to be watching for. And I'm going to tell you, go listen to that part and go gain an understanding because it's fantastic. Okay. If you haven't checked out our website yet, go check it out right now. ExecutiveREIShow.com. We got shows, we got resources, we got all sorts of stuff up there. Go check it out. Also, if you've been listening and you haven't had a chance to leave us a review yet, go to Apple Podcasts, go to Spotify, leave us a review, leave us a rating. We'd love to hear from you. That is a great way for you to show your love of the show. We really, really do appreciate that. We recognize it each and every single review that we get. So please go do that. And we thank you in advance for that. Lastly, before we get into the show, we got to start with today's executive tip. And today's executive tip, take your opportunities when they present themselves. That's one of the things you're going to find with Scott that he does often, right? Throughout his entire career, it was kind of these different opportunities, these different windows. And you know what? It's amazing what happens when an opportunity opens up and is all you do is just walk through, right? That's like all you have to do to get started. Just walk through the door of opportunity and see what happens next, right? And what ends up happening is usually that door leads to more doors, which leads to that door. You know, even if one of the doors burns down, you turn around and there's a different door standing there. Go through those doors of opportunity, take those opportunities when they present themselves, because that is going to lead you past this state of fear to a level of success that I don't think most people will ever achieve in life. So be one of the few that walk through those doors of opportunity, get outside your comfort zone. Now let's get into today's show with Scott Crone. Hello, everyone, and welcome to another episode of the Executive Real Estate Investing Show. So excited today. I have Scott Crone with me. He is the founder of what seems like 100 companies. We were just talking about it. He's founded, Coda Management Group, Coda Design Build. He's founded the One-Stop Self-Storage. He's the author of High Performance Homes. I mean, the list just kind of goes on and on, Scott. But welcome to the show. Thanks for joining us today.
Thanks for having me. I appreciate it. Maybe I had to do it so many times in order to get it right.
I love it. I love it. Well, Scott, tell us a little bit about yourself.
Well, I'm residing here in the city of Chicago, just north of it. And we developed our company. I began in 1998. And since then it's grown. We really began focusing on self-storage. We sold off our multifamily, but we've been able to expand our self-storage from Wisconsin all the way to Maine and down through Virginia and all the states in between there. So we're excited about our growth that we've been doing and where we continue to go.
Fantastic. I love it. Well, I'd love to kind of hear just a little bit more about your companies as we get going here. So you have Coda Management. Is that managing self-storage, or what is Coda Management specifically managing?
It's managing our real estate investment portfolio, which is currently self-storage. It began in different divisions of commercial real estate. So we had apartments, we had flex warehouse space, all those sorts of things, but we've liquidated a lot of that and have focused our attention specifically on self-storage. So that oversees all of our self-storage. Coda Design, go ahead.
That's you read my mind. That was the next place I was going. So tell me about Coda Design Build.
Coda Design Build facilitates our development side of things. So when we develop something, when we design it, we build it, we'll facilitate it through that company. So each of our individual companies will hire Coda Design Build to do all the work. And One Stop Self Storage, when we finish our development, we turn it over to One Stop Self Storage and they manage our client interface. So our customers come in and they'll rent through One Stop Self Storage.
That is fantastic. And I love that we're talking about self-storage because it is one of my favorite asset classes. We're doing a lot of it out in the West, in Utah and Arizona. I'm interested to hear, why did you pick self-storage, Scott? Why, you said you kind of liquidated everything and honed in on self-storage. Why self-storage?
Well, as I mentioned before, I began in multifamily, and that was my background. And when we began something, it was really, the field of dreams approach, build it and see if they will come, right? But with self-storage, it's a lot more predictable. It's a lot more consumer driven, and we can model that. And so it's a lot more predictable. But we also went back and studied the last 4 major significant recessions in the US economy. And our studies indicated that self-storage actually thrived during those recessionary markets. So I haven't seen any other division or product within commercial real estate which has done as well as self-storage during those periods of time.
That is fantastic. And you know what? That's honestly, I think you and I are a lot on the same page, because we felt the same way about self-storage, and one of the reasons we have such an affinity towards it. So I love that you kind of did your research and honed in on that. Now I want to kind of take a step back, go back a little bit to the beginning. How did you get started in real estate?
Well, I was 4th generation family business in the die casting world, and I planned on going into that and being the only male around the business. I had a younger brother, but my sister wanted to be a teacher, and my younger cousins that were girls, they didn't really express any interest in die casting. I can't imagine why. And and my parents showed up for a parents' weekend in college, and they said, "What do you plan on doing next year?" And I said, "I thought I'm going into the family business." And they said, "No, you're not." And I was like, "What did I do to piss off Grandpa?" They said, "No, we're selling the business." And so, that was a major fork in the road for us and our family. And, my dad, I pursued architecture in high school. My dad said, "Well, why don't you consider architecture again?" And, I thought I closed off that. I looked at technical schools for college, and then I looked at liberal arts, but I ultimately chose a liberal arts just because of 2 reasons. 1, I wanted to play sports in college, and 2, I wasn't 100% convinced of it. And if I was at a technical school and I didn't like it, then I felt I would be trapped. And so I went the liberal arts direction, and I found out that they actually had master's programs which allowed non-architectural based students to get a master's degree in it. And so it was a 3.5-year program. So that's how I got into real estate.
Awesome. So you started in architecture. I imagine that's obviously led the pathway to Coda Design Build. Are you still active in architecture? Did you make it sounds like you might've made a transition into more the investing side of real estate versus designing the real estate. Talk to me about that transition for you.
Well, my first professor was an architect who owned a real estate development company and contracting company that focused on multifamily. And so, I was his TA. So that meant in his mind, I had to work for him for free. And I quantified, I said, well, there's 20 hours that I'm supposed to work for you for my degree. So from 7 in the morning until noon, I would work for him in his office. And then from 1 to 6, I would work for him in class. And then from 7 until midnight, I would do homework for him. Basically from 7 to midnight, I was, working for this guy for, almost 3 years. But because of that, because I was undergraduate in liberal arts, I was predominantly the only one in the office who were the students I was the only one who could read a lot and process things. Everybody else loved to draw. But so he put me on the development side of things. And that's where I really learned the development side of the business. And so I would say that during my 6 years at that company, I probably did like 95% development and about 5% of the architecture, while a lot of my other classmates were 100% architecture. And so it allowed me to learn both sides of it. So we still facilitate the design, but in our projects, again, the design is less than 5% of the total project. So I'll complete a design within a week, and then we'll spend the next 3 years working on it.
Awesome. Well, that's really interesting. I love how you kind of took these situations in life, right? You kind of mentioned it earlier. You had these forks in the road, right? That you had to kind of pick a path. And it's really interesting as we're talking, you can see specifically in your life, there's these multiple times where you had to make a decision on which direction to go, right? The die casting, and then you had to switch from that. Well, I had to go to architecture. Well, then when you started in architecture, right, you probably could have pushed back on the development, said, no, I don't really want to be in development. I want to be more architecture, but you found an opportunity, and it sounds like you took it, which continued to lead you down paths. And I love how life works like that. I mean, it seems like when you're taking the opportunities that are presented in front of you, that's when more doors open. And so I love that you found that and this like progression through your life. I feel like that's what happens a lot in business and real estate investing.
Absolutely. It's just not the good forks, but it's also the bad forks, the challenges, right? I was just talking with someone yesterday, or on Friday, I should say, about, a challenge that they were going through. And I said, hey, the response was, well, I'm going to quit. And that's a fork, right? And
yep.
I said, well, you can use it as a reason to move away from it, or you can use it as a learning experience and lean into it. Your choice, your decision, but ultimately it's another fork in the road. And I think that a lot of people don't really see the negative challenges, but I think negative challenges have as much of an impact as the positive ones. So I think there's lots of forks that we can constantly pursue.
Oh, I love it. And I can definitely attest to that. I mean, one of the things that kind of came to my mind, just as a silly example, right? I remember we were buying some land for a small office development back when I first started at Overland Group, and it was a $5,000 earnest money deposit. Wouldn't that be nice nowadays? But it was a $5,000 earnest money deposit, and there was an option to an extend. And I called the agent and I said, yep, I want to extend. We're going to do it. Plan on it. It was over the Christmas break that I had to give that notification. Well, I had failed to notify in writing. I only had notified verbally. And so needless to say, they ended up selling to somebody else. They had somebody else in the wings that was going to pay more. They were just waiting and hoping that we didn't come through. And we lost that $5,000 earnest money deposit. Well, I can assure you that I have never lost another earnest money deposit again over something like that. So completely agree, right? Those hard things that we have to go through, those can shape us, make us understand, because it's what we want, but it's also what we don't want and what we want to avoid that really shapes the decisions that we make. So that was fantastic. 100%. Awesome. I love it. Well, so you were working for this professor, started as a company. Sounds like that TA position turned into a full-time job. When did you decide to go off on your own?
Well, it was another couple forks. My annual review was up, and he said, well, you should expect big things. You've been doing a great job. We're going to do this, this, and this. And then negotiations, when it came time to, my review and my compensation, didn't go so well as I'd hoped. Mm-hmm. And so I began, interviewing with other people. And one of them was the former CEO, the CFO of the company, who went and started his own development. And so I made the transition, moved over there, and I was brought in to assess an entire project, to run an entire 90 townhome development. And within the first month, I determined that this $3 million in profit project was actually going to lose $500,000. And you can only imagine the pressure that I put on the partnership and the three people that were the owners of the company. Yeah. And needless to say, for the only employee in the company, it wasn't a very stable position after that. And so, I could have made two choices. One, turn my tail and try to go back to my original company, or again, I saw it as an opportunity. I said to them, hey, look, you can't afford me full time, but you can afford me to leave because I'm the only one who understands the whole project now. So what if I work for you part time and it will allow me to start my own thing part time? And so that's what I did. And so at, the very ripe old age of 28, I went out and started my own company, and we bought a property, we tore down a house, and we built a new one, and we sold it. And then shortly thereafter, I departed the other company and just went full time on my own.
I love it. Well, 28, right? You garnered some experience. That must have been a little bit of a leap for you. Talk to me about what ultimately what led you to make that decision, and maybe what were some of the biggest hurdles and challenges. I know a lot of people that deal with this, and a lot of our listeners, in fact, have had to overcome this themselves. So talk to us about, what was that transition like? When did you decide to do it? And what were some of those early hurdles that you had to overcome?
Well, when I first decided to do it, when I saw how much money was being made in that field and how I was making that money for other people. And I was like, why can't I do this on my own? What is prohibiting me from starting this when I've seen other people do it? And that's probably the arrogance and the naivety of being 28 years old. So I'd say the biggest hurdle was, I still get carded today, and I just conveniently point out the bald spot on the top of the head. I'm like, really? But back then, if I was 28, I probably looked like I was 18. And credibility was a huge one. And I think it's the same thing for anybody who starts off their businesses. What credibility do you have in the marketplace? How do you prove yourself if you haven't done it before? And when I was coaching real estate, I always emphasize that people don't rely upon their past enough when they're starting something new, but the past forms us. The past determines where we've been and how we've gotten there, and it provides us with a lot of experience. And I don't think a lot of people really appreciate that when they're evaluating themselves and how they present themselves to other people. And so, when I'd have to go before banks, granted, I did have other people help guarantee loans and those sorts of things in order to get it done. But I relied heavily the fact that I was, a project manager for a $24 million project, and I was running a $57 million project and doing all these other things to show my experience that I had garnered over the past, 6-7 years. And so, that was the foundation of how I began. And it certainly wasn't easy. I mean, it was very difficult convincing, banks and investors that, 28, 30 years old, that you know what you're doing. And, fortunately, the market was strong enough that, we were able to do well and performed and advanced returns back to our investors. And so they were happy.
Awesome. Well, you kind of mentioned the real estate market, and I'd love to kind of get your thoughts, right? I mean, you said you started at 28, you have these great businesses, you've done a lot of things, developed and invested in a lot of things. I mean, really over the past 30 years of your real estate career, what trends have you seen in the real estate market?
Well, when I first came in and we had massive inflation, that was the early 90s, and the lenders were talking to us about buying points so that we could sell condominiums in order to give our buyers a more competitive mortgage. So I've seen that. I've seen shortages in drywall, masonry, steel, fuel. Those were the big ones. And we had the internet boom and bust, and then we had the real estate market bust, and then the pandemic recently. So those are the four main. I mean, granted, the pandemic's not really considered a recession based upon how the government's been propping up the economy. Yep. But the downturn was very sizable and noticeable, obviously in the first quarter and beginning of the second quarter of 2020. But those are the four major recessionary markets that I was talking about. And the biggest takeaway that I taken from those is that I need to be paying attention to the overall market. I can't get too far out over my skis. Being from Utah, you'd appreciate that analogy. But it's important to always have your pulse on the marketplace. And I've been fortunate enough to be aware of that and began pulling back. When the housing market crashed, we were only sitting on 2 properties at that point in time, and a lot of my competitors were sitting on 20. And I stopped buying because I saw too much pressure on that. And I didn't predict that the housing crisis was going to occur. I thought there was going to be a downturn, but the same sort of thing is with currently within the pandemic and what's going on. I began pulling back in multifamily 4 years ago. And most people might say, well, I pulled back too early. That's fine. I'd rather be too early than too late, because the backside is usually a lot steeper than the front side. And so right now I'm preparing for another recessionary market. We're thinking that we're going into recession, and especially some of the things that are being implemented from DC. And if those things continue, I think it's going to be a tough couple of years.
Yeah. Well, so with that in mind, right, you kind of mentioned, hey, I think we might be heading into a recession. Having been through these other recessions, these other downturns, what's the number one advice that you would give real estate investors right now in order to prepare yourself for a potential recession in the future?
One, you got to really make sure that you're not spending too much on any one thing, be it land or any other item in there, because costs are going to be really dictating your overall loan structure, which impacts your interest and how well you're able to weather the storm, what competitive advantage you have. The other thing is, as I said, not getting too far out over your skis. So making sure that you have proper leverage, making sure that you're going into solid markets, that you're not assuming that a market is stronger than it really is. And I've seen a lot of people do that in terms of where we live in the speculative housing market. Everyone's like, oh, this will never impact here. To put it in perspective, housing prices are exactly the same as they were 10 years ago. Now, that's not the same for everywhere in the country, but here in this market in Chicago, the literally homes that were on the market 10 years ago are retrading at exactly the same price. So if we had based upon that on speculation, there'd be a lot of hurt. And that's one of the reasons why we moved out of the speculative housing market here in the Chicago.
Yeah, that's really interesting. There's a couple of things that I really want to dissect from everything that you said, right? And so I love this idea, right? And this notion, don't get over your skis. Don't get too over leveraged. I'd love to dissect just a few details of that. So for you, in your investments, what are you seeing and what do you anticipate is kind of the right amount of leverage on a real estate investment nowadays? Let's say it's a self-storage, something run of the mill for you. What kind of leverage are you putting on that deal?
Well, we're putting around 70% debt to it, but we're also looking at what the debt structure is. And so any opportunity that we have to put longer term debt on it with the secured interest rate, that's what we're looking to do. So to make sure that we have long-term interest rates that, inflation is creeping into it. People say, how do you know? Well, I go to the gas station, I go to the grocery store. Everything is costing us more. Construction's costing us more. But, there's no doubt in my mind that inflation is going to be, impacting us. It's just a matter of how much the Fed can keep the throttle on keeping the interest rates low in order to propel the economy. That's the challenge that they're going to be facing right now, is with these rising costs, they're going to have to be pushing prime up, and that's going to slow down the economy, which is one of the main reasons why I think we're heading towards a recessionary market.
Yeah, no, and something that's really interesting. I love, because that's a question, honestly, I get asked all the time. You'd be surprised how many times I get asked that by new investors or people who are interested. Well, what's the right amount of debt? What's the right amount of leverage? And I think you hit it right on the head. I mean, what I love that you say, leverage is definitely a tool to be used in real estate. And for me, I tell people, look, there's a certain amount of leverage. It's too much leverage. But if you are smart about it, like what you're saying, look, we're trying to get locked into long-term rates right now and long-term loans where rates don't change. If you're getting into long-term fixed rate loans right now, I would argue to say that putting debt on your property instead of going all equity, and I have a whole segment about this, actually reduces your risk in the long term. And I won't get into that right now, but I think that what you're saying is honestly spot on, right? If you're looking at getting a deal done, I think putting leverage on it is a fantastic idea, but putting the right kind of leverage is crucial to the success of that project and you personally. So I love how you mentioned that. One other thing I want to kind of get into, right? You're talking about the economy, and I love it when real estate investors pull their head out of the real estate investing sand and take a look around and see what else is going on, right? And so we're talking about the Fed, we're talking about inflation. Where do you see that going in the near future? And how do you think that that impacts real estate investors?
Well, I think real estate investors just got around a major threat out there with the IRAs. If IRAs were going to be wiped out for investing in real estate, that was just going to be a huge hit. I mean, I can't tell you how many billions of dollars are probably invested in IRA money in real estate. So that was a big one to avoid. But, 1031s, capital gains taxes, all these mechanisms which people are investing to realize, tax shelters is a big factor that's still on the market, on the question in terms of what's going to be happening at the federal government level. And if those things happen, I mean, we've already lost jobs to oil. We're seeing supply chain issues that are raising prices. We're seeing labor shortages, which are increasing cost. And then if we're then impacting capital gains, those are like the four main segments or legs of the real estate economy. Plus the fact that the only remaining one is interest rates. So if inflation is rising, then that's going to be putting more uptick pressure on interest rates. I mean, those are the five pillars of real estate. So if we don't have any of those mechanisms to avoid, acknowledge our risk, the risk that we're putting in, and at least getting compensated for that risk with our tax returns, if that's out the window, if labor costs and supply chain costs are higher and then interest rates are higher, those are all mechanisms in my mind, which are going to be impacting a recessionary market within real estate. Now, the good news is for me as a real estate investor is that is the time when most municipalities are easier getting projects rezoned. It is also the time where if there's money on the table that we can get better pricing for construction. So that's the plus side, but getting to that point causes a lot of pain. So I think that's where we're going to be, is that pressure point of pain.
You're speaking my language, Scott. I spend so much time rezoning properties, getting capital, getting favorable construction loans on it. And I completely agree. I love what you're saying with these different pillars, right, of real estate. And if somebody's listening right now, I'd almost say go back and listen to those pillars again, because each of those pillars, right, inflation, interest rate, supply chain, all of those things you need to have an understanding of, right? You don't need to be an expert, but if you want to be truly a great real estate investor, right, and not just ride markets up and down and left and right and kind of get tossed to and fro, you want to have a little bit of control in your life. I think one of the best things that you can do is to listen to those pillars that Scott just mentioned again, and go and try and gain a little bit of understanding on them, right? Because what that's going to do is that's going to give you a broader picture of what's going on. Sometimes we put real estate in this vacuum and it's real estate, and it just shields off all the other negative or bad things that are happening in the economy or in the world. Nothing can happen because it's real estate. And it's not true. I mean, I remember I had a friend that was buying homes in 2006 and 2007. And one of the things he told me is, yeah, I'm buying homes because homes, they never decrease in value, right? That's not a thing, right? Like that doesn't happen. Yeah. And I feel so bad because we all know what happened just a few years later, right? And so you have to be able to understand what's happening in the rest of the economy. So fantastic advice from Scott. All right, Scott, I want to get to a few other points that you make here, right? So you talk a little bit about you have these mind-blowing facts of self-storage investing, right? And I would love for everybody to get a little taste of those 3 mind-blowing facts about self-storage investing.
Well, I think the first one is that, self-storage is well over $1 billion. It's healthily into the $1 billion industry, but only 10% of the American culture uses self-storage. And the second one is during the last 4 major recessions, occupancy only dropped on average 1 or 2% and then rebounded aggressively. So that's the third one. I mean, the second one. The third one is we're expecting to see another boom within self-storage because of the way in which people use homes differently now, post-pandemic. Housing, schooling, work, exercise have all been brought into the home. And I think there's a reluctance of people to really go back out into the marketplace. So as a result of that, where do I put the extra stuff? And that's where we're seeing we opened up 4 facilities during the recessionary market, and each of them exceeded our prediction, our modeling in terms of the occupancy during that period of time. And so, yes, it was different in the pandemic, but overall, we were very pleased with how our products performed during the pandemic. So those are the 3 major things within self-storage that we see in terms of some data and some knowledge that we've been studying and analyzing over the past 7 years.
Yeah, I love it. And I can attest to the things that Scott just mentioned. I mean, we had 2 of our facilities that were in lease up, and their lease up just almost accelerated through the pandemic. I mean, we had one property that pre-pandemic was actually, it was going a lot slower than we anticipated. We were kind of right on that cusp of everybody was saying it takes 2 years to lease up. We finished the building and everybody turned around and said, just kidding. It's not 2 years. Everybody needs to plan for 3 years now. And then the pandemic started hitting and everyone said, well, be prepared to plan for a 4-year lease up. And then we kind of got through a little bit of it. And that building, for example, took off and it was fantastic. And so definitely seeing the same things and can attest to what you're saying there. Scott, before we end, I have a couple of questions that I ask every single guest that comes on this show. So first question, what's the best business advice you were ever given?
Well, I have a great mentor. My professor was the first mentor that I had. And then I had a second mentor who is quite accomplished in his life. He moved here from Lebanon at 16 with about $300 in his wallet, put himself through college, and now he owns a couple Fortune 500 companies and is on the board of one of the largest banks in America and is the president of a university. And one of the things that he always says is, look at it, best case, worst case, and what most likely will happen. And if you can live with each of those situations, then go for it. But if you can't live with your worst case, then don't move forward with it. But also, if you get best case, then don't try to retrade it. Be happy with what you got, but always plan on what will most likely will happen. And I think as real estate developers, everyone wants to live in the best case world, but that's doesn't happen every single time. It probably happens about 10% of the time.
Exactly. You hit more singles and doubles than you do home runs, and you do strike out every once in a while. So all of those scenarios happen. Well, I love it. That is fantastic and sounds like an awesome mentor. So that is great. The next question, what real estate investing advice would you give other business owners or business executives?
Be very cautious right now in this marketplace. Make sure that your acquisition price is very conservative because, with the downturn, you have to be flexible. And the other side of it is flexibility within your product type. That's one of the reasons why we like self-storage is our ability to change the unit configuration, which, I can't do within multifamily. Once you have it, you have it. But within self-storage, we have a lot more flexibility with it. So keep your options open, make sure that you're constantly reviewing your data and adjusting quickly. Don't sit back and wait, adjust quickly.
Love it. That is great advice. Now, Scott, how can people get in touch with you?
Well, I appreciate it, Michael. First of all, if anyone wants to learn more about self-storage and they reach out to us, we'd be more than happy to give everyone a feasibility report that we did on one of our projects. So if they contact us at info@Coda, CODAMG.com. So the MG is for management group, but info@CODAMG.com. If they email us and reference this show, we will forward them a feasibility study that we've done on our project. And it's about 170 pages. So if you're having trouble sleeping at night, you could crack this thing open and it will put you right to sleep. But
there's nothing better than reading a good, long, 100 to 200 page feasibility study. I've done it tens and tens of times. It's fantastic, everybody. Everyone should take a turn doing it. It's like reading a textbook.
Yeah, just numbers and facts and figures. It's a thoroughly driven report. But what we like about it is it describes the overall market, not just that specific market, but the overall market and what's going on within self-storage and the things to look for and stuff like that. So we would be more than happy to pass that on to your listeners.
Love it. And as having gotten a lot of self-storage feasibility studies in the past, I would highly recommend that, because what that's going to do for anybody listening, that is going to give you a huge insight into the, not only nationally, but locally, what's going on in the self-storage space. So fantastic. And don't worry, everyone, if you're listening to this or you're watching on the video, we will have that email address in the show notes. We'll make sure we get it in there, along with all of the other social media or anything else for Coda or for Scott. We'll make sure that if you want to get in touch with him, you can. Scott, thanks for coming on the show. It was fantastic.
Thanks, Michael, for having me. I really appreciate our time.
Thank you for listening to the Executive Real Estate Investing Show. Ready to learn more? Go to executivereishow.com for more episodes and resources to help you create generational wealth through real estate investing. That's executivereishow.com.